This is Eric Muathe with Muathe.com with another quick educational video. Lately, I've been trying to sensitize you guys to a concept that can keep you out of a stock before it really starts dropping significantly. So let's take a look at some chart examples here to highlight this concept. Again, in some of my recent videos, I've been discussing this concept, and the reason I was doing that, showing you this method, is because I could see that a lot of the stocks that out there were starting to deteriorate. So let's take a look at PTON. Had a nice run last year, but just because it had a nice run doesn't mean it can't give back those gains. So let's take a look at this recent weekly closing high. You'll notice that there was a breakout attempt that recently failed. This is the weekly, and I'm just going to go through this quickly. Links to this method for more information, the links are going to be in the description of this video. But we can see a failed breakout there. That's what I call the first warning sign. And then there's a break below this weekly closing low. That's your second violation. And what that means is the exit was right there at about, let's call it 145-ish. Before this big drop from 145 to the current price. So if you understand the concept, it's very simple. It's a violation of two things. Number one, a failed breakout, and then number two is breaking below the base. In other words, once it violates its base, it's time to consider getting out, taking some profits, or hedging. And of course, as always, these charts are jam-packed with information. We have what looks like a bearish crossover impending between the moving averages. Not the strongest sign of momentum to the upside. We also seem to be threatening to break the weekly lows of late 2020. And that in itself is another timely area to watch for potential price deterioration. In other words, prices do need to hold and bounce above this area so they can stabilize. Otherwise, this can really start pointing down. Also, the RSI could break to fresh lows on the weekly. Another bearish sign if it happens, unless it finds immediate support. By the way, I should state that this method that I'm talking about, links are going to be in the description, works in the reverse way. So take a look at this. There was a failed breakdown attempt right here. It did not fail. In fact, it recovered back above that area and then would go on to break out of the range. So this works in reverse also. Once it cleared this area right here, all systems were go. Now remember, we got this move correctly last year based on the ultimate Muathe breakout. But that besides the point. Let's take a look at another example. Let's take a look at Tesla here. Two things to note. First thing is, if we take this monthly closing high, we see that there was a recent breakout attempt, a weak breakout attempt, I should say, because it never really gets to the price, but it's a failed breakout there. Now, the threat of breaking below the recent monthly closing low, if it stays below the recent monthly closing low, let's call it at about 655 or so. Staying below that price, not good. That would coincide with the RSI dropping below 69.1. Again, all that would not be positive. What is needed here is holding above this range so you can eventually break out in the months ahead. And also you need to stay above 69.1 so as to have the chance of continuing higher. Otherwise, this can easily deteriorate. Look at another example here, crypto related name. We see a breakout here that we can say that yes, it had a good run for about a week or so. Ultimately, this fails, and it is that failure that has brought it down. And then now we are breaking below the lows. Either this weekly closing low has been violated or this weekly closing low. So the sell signals are, or should I say, sell signals were there and here, with the chance of prices deteriorating. So be on the lookout for those two setups. Let's take a look at another one here. So here's a stock that has really come off the highs. We can see here recently in February was trading at 300 plus, now trading at 150. So clearly that's a 50% price cut. Now, is there anything on the charts around here that could have given you some idea that things were deteriorating? Well, this is the weekly. We can go to the daily, and the daily is going to show this clearly. So take a look at this daily closing high. We try to break out here and we fail, right? So we roll over. That's the first wrong. There's your red flag. Well, let's paint it red, right? So there's your red flag. Now number two is this daily closing low. We can say take this daily closing low there, was busted on the way down. So there's your timely get out of dodge signal. If you missed that one, surely there was another one right there. It slashed through those lows. In fact, it gapped down. So we can say another sell signal right there. So this is something I'm seeing in a lot of the stocks. So I bet some of the stocks you own in your portfolio are giving you those two bearish wrongs. And again, the links to this simple concept are in the description of this video. So remember, before it was trading here, it gave you clear signs there, and there that this was a possibility. Let's remember, the charts are neutral. It's our opinions that tend to cloud things. And so it is. Eric Muathe with Muathe.com. Love, light, light, love. Namaste.